the Commercial Property Podcast. My name is Suzi Carter. I am a chartered surveyor. I've been involved in commercial property in the UK for 30 years and I've done hundreds of commercial property deals. I'm here to be your guide through the commercial property market, whether you're an experienced investor or whether you're literally thinking about dipping your toe in the world of commercial real estate. I will be here talking to you about all kinds of things commercial real estate in the UK, and I've also got some fantastic guest experts who are joining me. So please do subscribe if you'd like to follow, and if you'd like any more help or information on commercial real estate, please do click www.suzicarter.com, which is my website, and you can find out all the ways I can help you. So stay tuned for this week's episode. Welcome back to the Commercial Property Podcast, and it's my great pleasure today to introduce Robert Schogger, who is the co-founder of MetSpace. Robert, great to see you.
Hello, nice to see you too.
Robert, would you like to just do an intro in terms of your background and kind of what you do in the co-working kind of managed office space?
Yes, I am the joint CEO and joint co-founder of MetSpace, which is a managed office business, which if you're not in the property sector, you're probably thinking, what is that? To MetSpace, managed offices are self-contained spaces that are fully furnished, fitted out, where an occupier can pay a single monthly figure that will include all the office costs and items needed to run their space. Things like rent, rates, utilities, maintenance, cleaning and broadband. And MetSpace has been around since 2018. My experience in the industry dates back to 1999, where myself and my business partner, current co-founder of MetSpace, set up a company called Reflex Managed Offices. So we've been doing the same thing for a hell of a long time. So that's my experience in the industry.
Fantastic. And so you've obviously been doing this a very long time, but obviously since COVID, I've definitely noticed that there's more and more entrants into the market because for obvious reasons, people working from home, more flexibility of space requirements. How have you seen the industry or your particular sector kind of change since COVID, from kind of pre-COVID?
Yeah, it's interesting. I mean, I think COVID accelerated the growth of our industry. As I said, it's been there for a long time. When we set up Reflex back in the 90s, it was the serviced office market, which was the only alternative to the office market, let's call it the traditional leasing market, where an occupier would want to occupy space and they'd go to an agent and the agent would make them sign a lease. We talked about this earlier, of somewhere upwards of 25 years. And I think at the time, before Argos came in, they'd be stuck on that lease for literally 25 years unless they managed to find 2 or 3 people to pass it on to. So as a landlord, it was fantastic. As an occupier, it wasn't fantastic. So over time, leases have been getting shorter. And what Reflex tried to do, we tried to sit between the conventional market and the serviced market and offer this thing called a managed product, which effectively could give people a choice, an alternative. And what COVID did to accelerate this was it meant that what accelerated this, sorry to go back, I actually think, so Regis are a big serviced office company, and what they did for the office market, they made people sit up and take note that there was this alternative to conventional leasing. And then WeWork came along, and everybody knows about WeWork because they made a documentary about them. But for all its faults, what it actually did, it made the occupier realize that there is this alternative to the leasing market or the rental market or to the occupational market. So people would say, I want a WeWork office. So that's how it changed. And then as COVID came along, what that meant was occupiers wanted to stay in business. They wanted to take office space, but they didn't know what their plans were. So they And landlords who had empty buildings were very nervous that they were never going to find an occupier again. And they had banks, or they were relying on the rental income for their living, needed an occupier. So it shortened the expectations of everybody, and businesses could think about their business without worrying about fixed commitments for long term. Because I don't think any business really stays the same after a few years. They'll grow, they'll contract, they'll move. It's a fluid thing, a business. So I think COVID changed things. It just accelerated the market.
Yeah, no, that makes perfect sense, and certainly the market seems to be in flux now. There seems to be like a general sentiment of moving back to the office, doesn't there? But it's so different between each sector and each type of business. So
yeah, and I think managed offices are a term that's now. I guess if there was a trending scale, I reckon managed would be top of the trending scale in the market at the moment. And I think it's difficult and it can get confusing for landlords. I think it can get confusing for agents, for occupiers, because when you're in the middle of any growth cycle, any growth market, you have companies jumping into that sector. And you have a lot of companies jumping into that sector that don't quite know what they're doing, but they'll take that term managed and say, this is what we do. And I'm not, disparaging on anybody, because there are some great companies out there that do it very well. But I think it's about trying to find what managed actually means. And I think that MetSpace does it very well and is quite true to the term managed, which is what I explained earlier, this all-inclusive product.
Yeah, no, definitely. But I suppose, so not every managed office approach works.
Correct.
And I presume that differs across kind of regions, locations. So how do you, you're obviously very much concentrated on central London.
Yeah.
But how did and there's I presume there's pretty obvious reasons behind that in terms of the volume of businesses. But how do you kind of do your market research when you're going into a location? How granular do you get on that?
Our view, David Kluwer, who is my business partner, our view has always been that in any cycle, in any property cycle, and we've both been in the industry since the mid-80s, when things and it is a cycle and it is up and down. And when you're at the bottom of the cycle, if you are in the industry and you want to stay in the industry and still work in it, you need to be in the right location. And as long as you're in the right location, and for us, central London is the right location. For all its faults and whatever people do or don't believe in, London is its own market. And most businesses aspire to be in London, to have a base there. And then there are micro markets of London. And if you are around Oxford Circus, Tottenham Court Road, Soho, now other train stations like King's Cross, Victoria, those sorts of things, access to mainline stations, that's what's vital to the ability for a landlord to be able to let his space. And that's what it's about at the end of the day. As long as there is a demand for office space, you will be able to let it if you're in the right location.
Yeah, no, absolutely. And how do you assess the competition, or is London such a vast market that you don't necessarily need to get as detailed with that competition analysis as you might do maybe in the regions? So kind of how do you work out the capacity of those particular markets?
Well, that's a good question. That's quite a difficult question to answer, because it comes back down to, competition is healthy. When we started Reflex in the late 90s, it was difficult because we were starting out a business where nobody else was really doing what we were doing. There were serviced offices, there was conventional offices, and there was us in the middle providing this product in townhouses where there was no reception, but there was a room with desks, chairs, phones, a fax machine back in the day. People probably won't know what that is. Broadband, all the essentials of running an office. And it's what MetSpace is today, but just a sort of a larger version of that, larger floors. So the competition, it's good when there's competition because it means that you're in the right space and other people are doing it. And I think that we're in a sector, a sector and a subsector, London, office market and London, where there's always been demand for office space in central London. So we know what we're doing. We know how to do it. We know what occupiers want. So we can provide that product. And then it's just a question of where we go. And at the moment, there's good choice because, I mean, we might touch on this later. There's a lot of empty office space and there's a lot of secondary office space out there that needs to be brought back to life and improved for, sustainability, EPC reasons. So, MetSpace has a product that works. So yeah, that's a really long-winded way to answer your question, and I'm not sure I actually answered it.
No, I think that's a great way to answer the question, because actually, I think we're all programmed to think that competition is bad. But as you know, and I know, having worked in the industry a very long time, is that, for example, in retail, sometimes having the same kind of operators together can actually work really well because it becomes a destination. So it's that similar type of principle, I think, isn't it? That, if there's demand, if you can do it better than other people, then happy days.
Yeah, absolutely. Absolutely. It's very difficult to go to a landlord and say, this is what we do. This is why we do it. And believe in us. And they say, well, who's your competition? And you go, no one's doing it at the moment.
Yeah.
I totally understand the reticence. And that's what it was like in the early days. And then that's what it was like in 2018 again, but we had a bit of a track record. And now we're, 2025, 7 odd cycles on. And we've, got almost 60 floors and only sort of 20 odd landlords. So MetSpace is building momentum as a result of there being competition.
Fantastic.
I don't want to mention who they are, but some of them do a good job for us, a good PR job for us because that's what they do.
Yeah, good. And your model is a rental model rather than a purchase model, or do you do both?
It's a rental model. We partner with landlords, so we enter into operating agreements. Mine and David's, our background is mine's commercial investment property, his is residential investment property, and we were friends before we were business partners. But we took a similar path, left school at 17 and went into sort of the property industry. And my job was to advise clients on the sale and acquisition of commercial investments nationwide. Back in the day, companies like Sun Life of Canada or Prudential, those sorts of companies. Private individuals, 25-year leases, FRI terms.
Yeah, those misty-eyed days.
Wow, yeah. So, and David's was the same. So we've got when we set up MetSpace, Reflex was a traditional leasing model. We would go and take a long lease on a floor, 15, 25 years. And, we're buying long and selling short to occupiers. We thought when we sold it in 2015. We had a non-compete clause. And we had a good few years to think about wanting to do it again and how we would do it again. And we tried to look at it from the perspective of a landlord. What would a landlord want? What would a supplier want? What would an occupier want? So there are effectively three main clients, and all of them are clients. And how could we sit in the middle and service their needs as efficiently as we possibly can? And from the landlord's perspective, it was about giving him access to our knowledge base and our expertise to be able to generate income from the space with making sure that there's suitable risk on both sides. The old age-old question: what's in it for you, or where's your risk? That comment that seems
where's the skin in the game?
Yeah, where's the skin in the game? Correct. So we thought of the hotel model, where you have operator agreements, where someone can own a building, then somebody else comes along and manages it under an operator agreement and will share the revenue. Yeah. And there's the perception for the landlord is, there's more risk to that. But because leases have got shorter, there is, and the perceived risk, once you explain it correctly, goes away. And then we can demonstrate this ability to share the revenue that we get. Then it becomes a lot easier for a landlord to accept. So that's kind of how the model works. It's an operator agreement. We share the revenue, and the landlord will generally earn 20 to 30% more net return on his office space than he would if he was to let it on a conventional lease for 5 years.
Nice.
And it's just maths. It's pure maths. We've said we've got almost 60 floors and 20 landlords. Every time that the hard work is doing business with a landlord. Once they've done it once, they see the benefit of it and they love it.
Yeah.
And it works. I said, and we think we're really good at it.
And they're minimum term contracts, or kind of.
Yeah, the operator agreements are a minimum of 5 years. Some of the latest ones are 10 years. Because what's happened is we started on a 5-year agreement with somebody, and because we're coming into a new cycle of where we're renewing them, some of these new landlords have said, why would we not want you to be there for 10 years? So we're renewing them for 10 years. And the average stay of an occupier on our floors, these self-contained floors, are probably 3 to 4 years.
Okay.
So there's a decent amount of time. So if you look at the statistics, that what we're actually doing is we're taking an office floor, we're refurbishing it, putting furniture in, we're finding an occupier, we're saying to that occupier, we're saying to the landlord, spend the money now and refurbish it now, and we will provide the furniture, so we will share the risk, financial risk with you. Mm-hmm. We will then find this occupier for the space, and we will manage that occupier. And that occupier will pay this one figure on a monthly basis, and we will make sure we service that occupier's needs, because our belief is that an occupier doesn't leave a space unless they've gone out of business, or they've outgrown you, or you're a bad landlord.
Yeah.
And that's just the reality of businesses. They don't want to move. They want to focus on their business.
Yeah. Yeah, that makes perfect sense. So kind of taking that one step further then, so you obviously provide what occupiers are looking for. So what do they particularly value, and how can landlords and kind of investors kind of capitalize on that?
What do occupiers value?
Yeah.
I think good service, reliable service, getting their needs met, which is, I think, what we're all about now, getting our needs met. A space that works for them.
And so specification is important as well.
Yeah, really important. I think a lot of the time, when we talked about people coming into the market, the traditional leasing market was all about, I have an empty floor. I'm coming from a landlord's point of view. I have an empty floor. I want to let it. I'm going to give the keys to the agent. The agent's going to market it. The agent's going to say, no, don't necessarily need to refurbish it. I'll find you an occupier. And then the negotiation is either a larger rent-free period where the occupier is spending money, or depending on how much money the occupier is going to pay, the landlord might spend the money on the space and give him lesser rent-free. And that's where the negotiation is. Yeah. And that's changed because the landlord, the way the market seems to be, and I don't think this is changing, unless the landlord spends money on his space, he's not renting it out.
Yeah.
I think that's a given now for the central London office market, because I don't think occupiers who want to take a 2 or 3 year commitment are prepared to spend hundreds of thousands of pounds fitting out an office space that they might end up leaving.
For sure. Yeah.
So the occupier the landlord has to spend the money. Then the question is, how is he going to spend the money in the right way? So the landlord's biggest fear at this point is, how do I spend the money in the right way? And the advisor to the landlord, which I think is really important at this point, is he's got to advise the landlord to spend that money in the right way. And so often we go and have a look at office floors where the landlord has spent the money, and they might have put down, I know this sounds really silly, but they might have put down the wrong flooring, or they might have put one meeting room and a tiny kitchenette with one microwave in and it's 5,000 square feet, which might accommodate 150 to 200 people. So they'll be queuing for 2 hours for lunch. So it's a thoughtful approach on how to refurbish the space and how to get it occupy ready. And that's how we started. I think the market has caught up with it, and I think agents and advisors have caught up with it. And then it's about being able to find somebody who can access this managed market, which is very different from the conventional leasing market.
Yeah.
I think there are tiers to this new market, and I think it starts with, we talked about this earlier, having the right advisor. I think if you've got the wrong advisor in anything property related, you've got a problem.
Yeah, absolutely. Totally agree with that. And your approach differs from the WeWork approach, because they took longer term leases, didn't they, from what I remember, and then they let out on shorter terms. And obviously the inherent risk that came with the levels of rent they were paying on their lease versus occupancy rates, that's kind of where they came a cropper.
Yes.
Using a technical term. Yeah.
Yeah. I don't know. Watching that documentary, I think they came a cropper for a few other reasons.
Yeah, I think so too. Yeah.
Yes. Yeah. Ours is different. We said we enter into these operator agreements, and it is a very transparent transactional relationship between us and the landlord. So we are driven. We don't charge our landlord clients management fees. Once we enter into an operator agreement, we will buy the furniture. So we've got financial skin in the game. We will put the broadband in, and then we will find an occupier. And once we find that occupier, we will share the revenue. And only once the landlord has got his share of the revenue will we then take some money out of it. So the idea behind it is, have you got skin in the game, MetSpace? Well, yes, because we spent money on the space with you, and that's our cost. And then we are driven to let the space, because if we don't let the space, we are not getting any money back.
Yeah.
As opposed to other people that might put a management fee in or put their costs through a waterfall. And where we differ from building wise, WeWork took buildings, self-contained large buildings, chopped them up into offices, had communal breakout areas, communal conference areas, kitchen areas. Ours are, if that is sort of the picture of that as a business, that's a serviced office, a business center. Ours is a floor for an occupier that's fully fitted, that will have the amenity space within their office that is theirs. So as I said, so people can be in a serviced office, have shared space, or they can be in a MetSpace floor where they can have their own self-contained space, breakout area, phone booths, comfort seating, etc.
Yeah, nice. The interesting model. And how do you include, obviously the sustainability is on everyone's lips now, and everyone's looking for it, investors, etc. So I presume that you're pretty hot on that. How do you incorporate that in your business model?
Well, I'll put my hands up. I am not a sustainability expert, I'm pleased to say, but we do employ consultants and have people work for us that are experts in sustainability, and our contractors that do our fit outs are all aware of the our refurbishment sort of model and what we're trying to achieve. So everything we do is about sort of upcycling, recycling, the sort of lighting we use, the flooring we use. What we're trying to do is, there's a lot of grade B office space in London, and there's a lot of office space that is going to fall foul of the EPC ratings.
Yeah.
And what we do is we will improve the EPC of a landlord's floor with the materials that we use because of the nature of the products.
Yeah, nice. Yeah.
So it benefits an investor. So another reason why people should partner with MetSpace landlords, apart from the generous returns, but we will bring your building to the correct ratings from a valuation perspective or a funding perspective, because unless you're, I don't know, and then they keep moving the A, B, and C, don't they? But unless you're C and above by a certain time frame, I think you're going to have a problem. I think banks are not going to lend.
Exactly. Yeah, exactly. Commercial EPCs are all about carbon, so it's pretty complex to work this stuff out. But yeah, that makes perfect sense from a landlord investor point of view, for sure.
Yeah.
And you mentioned valuation there, and that's definitely a big area of interest for this kind of model, because it's not traditional, is it? It's not your, as you said, like 10, 15-year lease with RPI linked rent reviews. So how are valuers feeling in this space? Kind of, are you having a few difficulties with valuers? Kind of how's that?
I think valuers are feeling nervous at this point.
Yes.
Because they're going to have to get their head around valuing something in a different way, in a new way.
Yeah,
is what I think. I think they were probably hoping, and the same with a lot of traditional agents, that this would go away. This sector, this market, and it hasn't gone away. This operator agreement market. We're fortunate enough that quite a few buildings have traded and been sold with MetSpace as an occupier. I think my personal view on how it can be valued, I imagine there's 3 or 4 different ways, but one of the ways I think is the quality of the operator will come into play. So MetSpace is 7-8 years old. We've got average license lengths. Our occupier clients stay for 3 to 4 years. We're profitable, strong balance sheet, good turnover. Bearing in mind we are a reseller of office space, that's what we do. What value do you place on that? I would have thought you'd place a higher value on that than you would on a company that's been doing it for a year with no track record. Mm-hmm. And then you would probably look at there's more data coming through about what gross, and then you'd look at, I guess, there's the gross prices that landlords are receiving for the space. What does it net back to? And what, in the old days, when you would value a high yielding industrial building or an over rented property, what you would do is you would take the rack rent, the basic rent of what it should be. So if it was producing £100,000, you put a yield of X percent, 7% on it. If you were receiving £150,000, but it was really £100,000, you would value the £100,000 at 7%, and the extra £50,000 you would value at 12% because it's not real. And when the lease expires, you'd have to rent it at the correct lower rent. So I imagine it might be something like that, where they would take the top slice of income and value it that way. So they do a basic value and then the top slice. I don't know. I'm guessing here. But I think it's difficult for them, but they will have to change and they will have to find a solution.
Yeah, for sure. Not just in offices either, I would think that this is quite relevant for lots of different, because this kind of model is, shorter leases, more kind of partnership between landlord and tenant. It is becoming much more common now, isn't it, than it ever was?
Yeah. I think the occupiers' needs need to be considered. They are important. It's not just a landlord's market. It's flipped into an occupier market, but it can be a both market, if you like. I think we'll probably look back in 20 years' time and go, this was the time when the office market changed.
Yeah, for sure. And at the end of the day, if you've got a office unit that's not lettable, and this is a model, like, it's got to be a massive upside for landlords, hasn't it?
Yes. Yeah. It's just a landlord has to, if you owned a building pre-COVID and you've owned it for 20 years pre-COVID, you've got to get your head around the fact that you've got to do something different to it.
Yeah.
If you have it, you're an expert in advising people. So, I think that as well as I do that unless you invest in the property and the asset you own, it's going to fall into rack and ruin. So sure. They need to look after it. And if they do it now, then they should benefit from decent returns.
Yeah. Yeah. I mean, it's either that or pivoting into a different, into residential, which won't work everywhere. I mean, it does work in London largely, but it won't work in a lot of towns and cities across the UK. So to have this kind of model, is a great solution for, I mean, I've got lots of clients who are doing this model in a different way. They're kind of, rather than that partnership model, they're kind of actually setting it up themselves. So they're kind of putting lots of different uses in, from health to small offices to storage, all kinds of things in one office. And, I think those kind of more creative solutions are really important.
Yeah, definitely. Yeah, definitely. And I think occupiers are prepared to pay for quality. That's the bottom line. I'm not necessarily talking about gold taps and, necessarily expensive, flooring but good quality being the level of the service you get, something that's aspirational that is maybe beyond their financial reach.
Yeah. And what kind of operators do you get? Would you say it's kind of generally medium to small businesses, or do you get a real mix of?
A real mix. What I think's changed is we've got some blue chip companies, and blue chip companies, I mean some FTSE 100 companies, subsidiaries, which back in the day, back in the 1700s.
We were both there then, so don't go too far back.
I remember sitting down. It was 2000, early 2000s. We just started Reflex. We went to see a bank manager. It was a time when you had a relationship manager, and you could actually go and chat with them. And he told us that his bank, it was one of the big banks, that they wouldn't lend money to somebody who was in a serviced office. That they feel very uncomfortable. They wouldn't, but they feel because they saw it as a temporary, or if somebody had a PO box, it was all felt very fraudulent from their perspective.
Okay, yeah.
And that's changed. That's changed a lot, and I think it's for the better. So it's become a very legitimate way to do business, having an all-inclusive product. Yeah,
and makes perfect sense in terms of overheads and all that kind of perspective from an occupier's point of view.
Yeah, and so the SMEs. So it's always been. It kind of started out. It was always been 1 to 10 people, sort of micro businesses, if you like. But then it's spread, and these corporations, and the Women's Super League broke away from the Premier League, and they've now got their own entity, and they've taken space with us. We've got a massive bank, said, and a couple of other FTSE companies, and I think it's become acceptable to take a managed office or takes a floor in a space or some serviced offices, because businesses don't know what they're going to be doing in the next couple of years. And this is where landlords have to be more flexible, and valuers have to be more creative and thoughtful, and lenders have to be more aware and open. Otherwise it will stifle investment in the market.
Yeah, no, that makes sense. And so what kind of marketing do you do to occupiers? How do people know about you as compared to other kind of managed offices?
There's an agency side to our market called sort of the broker market, the flexible broker market. We work very closely with them. I'd say all our leads come through there.
Are they traditional commercial agents or different type of company?
No, they're different. They're different. They're different. And again, they were probably seen as kind of a sub, probably looked down on by traditional agents, I would have thought, for quite a long time. But these guys have been around since we started Reflex in the 90s. So they've been doing the same thing. And they advertise to a different sector, to a different market. And some of them are still going. And they concentrate, they know how to access, they not only know how to access the occupier and where to find them, but they also understand the model from our perspective. So, and I think this is where traditional agents probably need to think hard about what they're doing, because a lot of their client base, and I'm talking about a size of maybe between 1,000 and 5,000 square feet, because that is our sector. So everything is about that size. Those companies will want to consider managed offices. They want to consider products under 5-year leases and all inclusive. So, the traditional agents need to understand our sector, and they need to embrace that. Otherwise they will struggle, I think.
Yeah, that makes perfect sense. Yeah, no, interesting. So what do you think the future holds for the managed office sector? Obviously, really evolving at a rate of knots. Sounds like valuers have a little way to go in terms of their understanding. But it sounds like these things are being lent on and financed. So kind of where do you think, both from an occupier's point of view and from a kind of investment point of view, where do you think the kind of what the future holds for this kind of sector?
I think that it's only going to keep growing. I don't know at what rate of growth, but it's definitely going to keep growing, and I can't see it running out of steam anytime soon, because I think we're at the beginning of this sort of evolution in how occupiers occupy space. And there's a lot of office space that needs to be occupied. So I think that I think it requires a lot of parties to get their head around this new way of doing business in the commercial office sector. I think it's the owners, the valuers. There's only so long that an owner can say, no, I'm not going to let it unless you find me someone who I can give a big rent free to and I'm not spending any money. How deep is his pockets? 1, 2, 3, 4 years? I don't know. And then when banks or valuers are receiving properties that have got more and more of these type of fully fitted solutions in them, and even if it's not a managed office and somebody refurbishes a floor and fits it out, the chances of the occupier of taking a lease longer than 5 years with a break at 2 or 3 is slim, really slim to none, unless it's a headquarters building and they know what they're going to do for the next 10 years, 15 years. So leases are getting shorter. That's just a fact. And in terms of our market, I was talking to somebody a good few years ago, and that the model in America, in some states, are people will pay a premium to know that they are in a building that is managed by that company. And that is where I think this market will go. If you are and this is what we try to do at MetSpace, we're trying to create a brand that if occupiers want a MetSpace floor, they know what they're getting. And if a landlord partners with MetSpace, they know what they're getting. And then that will receive a premium according to the quality that we provide, which is, we think, I'd say first class, because that sounds like an airline.
First class is good.
But top, we like to think we do everything well. We're very thoughtful and considered to all our clients.
This episode is brought to you by Bond Finance Limited, your trusted partner for commercial property mortgage solutions. Are you an experienced residential property investor about to diversify into commercial property, looking for funding options? Bond Finance can help. Whether you're planning to expand, refinance, or make a major property investment, Bond Finance provides expert advice with access to a wide range of lenders, from high street to specialist. Book a free discovery session today to explore how we can tailor commercial funding solutions to your unique investment strategy. Visit www.bondfinanceltd.co.uk and take the next step in your commercial finance journey.
All three clients.
Yeah. And do you provide like some serviced office operators provide like gyms and social events? Do you just literally provide the office space? And
yeah, the office space. We if you've got a building of 10,000 square feet and there are 5 floors in it, we will take all 5 floors from you, or we'll take 1 floor from you. We don't mind, but we don't run services outside of what we do. We just focus solely on generating revenue from that office space. How much revenue can we generate from the office space while keeping everybody happy?
Yeah, a much simpler model, which
yeah, it's difficult. We're fortunate enough to have, David and I have worked through. Well, there was 2001 when the Twin Towers came down, so that was one dip. There was 2007, I think, and there's COVID. So we've kind of traded through 3 recessions, and the patterns are the same. That when a business is going well, this is from an occupier's perspective, when things are going well, they don't necessarily spend as much time worrying about the services and the gym memberships and the meeting rooms they're booking and all this extra stuff. But as soon as times are tough, they cut back on the services.
Yeah.
So our fear was always, if you built a business based on extra service revenue, the reliance upon that is very, it's unreliable. It's good in a good market. In a bad market, as long as there's a demand for office space, it comes back to the same thing. I need to rent office space. And then, we noticed just after 2001, our occupancy stayed very, very high as a managed product, but our revenues dropped. And we started getting clients from serviced office companies, because what happened was they were paying X pounds a foot or per workstation, and they started to notice that the sweet bowl wasn't getting filled up, or the flowers weren't getting changed every day, or there was 1 receptionist instead of 3 receptionists. And there were things of, well, I can't pay for these extra services and I'm going. So that was kind of the rationale behind how the model has evolved and sticking to our core principles. And
sounds fascinating. It makes perfect sense, actually, when you say it like that. And so this is a question I always like to ask guests on the podcast. Kind of, what's your view on kind of the market, where the market's going over the next year or so? And obviously it's high stakes, this kind of question, because we're all bound to get it completely wrong. So there's a big caveat on it, but I always like to kind of just get people's gut feels on it.
Yeah, I feel like Mystic Meg.
Get your crystal ball out.
Absolutely. It's just, you've got to bear with me. It's just a little bit cloudy at the moment.
Funny enough, mine is too.
Yeah, I should have brought one of those 8 balls that you've got the LED displays that you shake and it says something like, I don't know, 47 on it. Or
yes.
You want chocolate. What do I think? Where the market going? I don't know. I think for my particular sector, the office market. I think there is demand for the office market. There is demand for offices in central London. You have to provide good quality offices in order because there's choice. I think businesses generally are very concerned about how they're going to spend their money and where they're going to spend their money. So they will only move if they have to. Probably think growth is a little bit sluggish and anemic across the board. I mean, there are some sectors that will be pushing on, but generally speaking, I think what's really difficult from an investment point of view is what the question I think people are probably asking is, what is something worth? And I think that's a really difficult question to answer, because it genuinely is only worth what, if you've got a buyer out there, it's very rare that you would have 4 or 5 buyers trying to buy that product. So I think it's a challenging market, but there is a market out there, and it's just, you've got to be, have your eyes wide open and be aware that I think property for me is something you have to think about as a long-term asset. And if you don't, and you're looking for a short-term gain, if you are the wrong side of the cycle and you're poorly funded, you've got a problem.
Yeah. No, very, very sage words. And I think we were talking earlier, I think, in terms of trends and kind of where things are, and the winner, whereas all landlords used to be winners back in the 80s, unless you were really unlucky. Now there's definite winners and losers, and your model definitely has all the feels of something that really is catering to the trends in the market right now, which can only be a good thing, right?
Yeah. We give landlords the opportunity to rent their space for the best possible price. And there are markets exist. The retail warehouse market's really strong for I don't know about other sectors. I say that because I have a friend who works in an agency firm, so I talk to him about it a lot. But yeah, residentially, I mean, if you're a residential investor, letting flats, if you've got lots of them, I imagine that's a strong market. Not as strong as it was, but you've probably got a lot of occupiers. I reckon residential development, probably tough. I mean, what do you think?
Well, yeah. I've definitely noticed through my own investing and through what clients are doing, there's the winners and losers. So the secondary office, on the face of it, is, in inverted commas, a losing sector because of the race to grade A, but the pricing now of secondary offices and the fact that you can put models such as this into it means that I would imagine it becomes much more viable because of the value decreases in the sector of that type of thing. Certainly where a lot of clients are doing some good stuff is taking larger industrial units and subdividing them into smaller space, just because that kind of space doesn't exist in some markets. So they're doubling rents. A lot of mixed use is doing really well. Commercial on the ground floor and resi uppers, that's doing really, really well. As you say, retail warehousing doing well, pockets of industrial. I mean, at the larger scale, you've got data centers, life sciences, all kind of doing pretty well. But I think we are in a bit of a wait and see mode in terms of where the market's going, for sure. I don't think there's any reason not to invest. I think you just need to make sure you buy for the right price if you're investing and have the right occupiers.
And do your investors, if they have to get bank funding, are they struggling with that?
No, actually, the lending criteria has relaxed recently. Certainly for SME investors, has really relaxed recently. So I think banks have been feeling more confident and more comfortable. That a lot of banks were lending on vacant possession value. Now some are pivoting into market value depending on the type of asset. So I can definitely see. It's kind of winners and losers, really. It as every market, but I think that's going to continue now in the commercial property market. It's about finding a niche that really works for you and works in your particular investing location. Exactly what you've done. You found a niche in central London that just works for you. If you were to pivot that model elsewhere, it may not work. But kind of really understanding your market, building relationships in those markets, and that's where the success is, from what I can see from clients, is working well. So, and
your clients, the advice you give, is it nationwide or is it?
Yeah, I've got clients all over the place, actually. Yeah, Scotland, Wales, lots in the southeast. Okay. But yeah, I mean, the game's slightly different at an SME level because I've either got business owners who want to buy occupational properties or want to invest profits, right, or SMEs who want to get money out of deals, all money out deals by adding value, doing asset management plays. And that certainly is very, very possible in this market in terms of adding significant value, finding properties that have been mismanaged, you know, all the basic stuff that you and I know about. So anyway, I'm not quite sure how that turned into an interview to me, but but really interesting questions. I mean, we could literally debate this till the cows come home. But I mean, I always say, like, when you try to predict the market, you either, people are going to look back and think you're a great genius or the biggest lunatic out, because you know it's just difficult, isn't it, to call?
Yeah, very difficult. Very difficult. I think there needs activity. A market needs activity, regardless whether it's up or down. It needs activity, and I think probably been suffering from a lack of activity for a while. So hopefully, the people in charge, the bankers, the politicians. I'm not sure politicians determine, but hopefully they can kickstart and boost market activity, just get it moving a bit quicker, because I think that helps everybody. You know, it's a big machine, and there are a lot of people that need to be fed from it, I think.
And sentiment to improve as a result. I think that's really important, isn't it? So
yeah, definitely.
Yeah. Great. Well, fascinating model, Robert. Thank you so much for joining me. And how can people, like landlords or occupiers, how can they get hold of you certainly landlords, to get hold of you to talk about your model?
They could email MetSpace. London Limited is the trading name, is the name of the company, and then send us a message, and we'll come and meet you and partner and have a chat with you. Yeah.
Perfect. Yeah, what we'll do is we'll share your details, and we'll share MetSpace's details in the show notes of the podcast, so that
thank you.
Everyone can get hold of you. But yeah, no, really fascinating discussion. Thank you so much for joining me. I think this is so interesting, and you know, I'm seeing lots of investors really interested in this space. So I'm sure that this will kind of definitely grasp people's imagination. So Robert, thank you so much for joining me.
Yeah, thank you for having me on. Really appreciate it.